The percent of sales method is another way of predicting a company's external financing needs, but it allows for more finessing and fine-tuning and adjusting of separate accounts. What you do for the percent of sales method is you calculate based on the most recent year of data what proportion sales were or an account was to sales. So even though I have this number typed in, I'm going to show you how I calculated it. So in 2012, cash was $20 and sales was $2,000. So if I take 20 divided by 2,000, that gives me that 1%. Inventories were $240 relative to $2,000 worth of sales. So if I take 240 divided by 2,000, that gives me that 12%. So all these cells that have a percentage figure in them, I took the current value of that account and divided it by sales for 2012. Next, what we do is just assume the next year will follow the same pattern. So if our cash and securities was 1% of 2012 sales, then we'll assume there'll be 1% of 2013 sales. So I have to predict 2013 sales. Here we're assuming a growth rate of 25%. So I'm going to go down to the sales figure for 2013, start with 2012's sales and increase it by 1 plus this growth rate. Now I can start filling in different accounts. I can fill in every account that has a percent of sales figure in it in column C. So I take this 1% times sales for 2013, and I'm going to make that an absolute reference so that I can just copy it down. Actually, I'm just going to Control C, and then I can Control V into every cell that has a percentage sign in it. Just take a quick look at it to make sure it did it right. Trust but verify. Now I can complete my balance sheet. To find my total current assets, I would just sum cash, accounts receivable, and inventory. To find my total assets, I would sum current assets plus fixed assets. Now the percent of sales method still follows this general format. I want to figure out the increase in my assets, subtract the increase in my spontaneous liabilities, and subtract the change in retained earnings. But it doesn't calculate things exactly the same way necessarily. To find my increase in assets, I can just take my predicted assets for 2013, deduct my actual assets for 2012. So I expect assets to rise by 250. Now, to find my increase in spontaneous liabilities, I can take 2012 or 13's expected accounts payable and accruals and subtract 2012's actual value. So take this 125, subtract the 100. To find my change in retained earnings, I need to come down here and go through my income statement. Well, I've gotten all the way down through fixed cost, so now I can calculate earnings before interest and taxes. Take my sales, subtract my variable costs, subtract my fixed costs. Now the problem is interest. If I need to borrow more money, if I use debt as an external source of financing, then I'm going to owe more interest. But I don't yet know if I'm going to need debt as an external source because I haven't actually calculated my external financing needed. That's what I'm doing with this project. So what we do initially in what we call our first pass is just assume interest will stay what it was the year before. Now we know that's probably wrong, but we'll deal with it in a bit. Now I will calculate earnings before taxes by taking EBIT and subtracting interest. My taxes will be 40% times my taxable income, and my net income will be earnings before taxes minus my taxes. Dividends will be 30% times my net income, and retained earnings will be my net income minus my dividends. So 4578. And I'm just going to link that to change in retained earnings. This is a little bit different than what we got when we used the equation. I can't remember the exact number when we used the equation, but remember, the EFN equation assumes that profit margin is going to stay constant. And just so we can evaluate it, I'm going to put net profit margin here. So in 2012, my net profit margin was the net income divided by sales. So it's 2.52%. And in 2013, using the process that we use to calculate our income statement, our profit margin would be net income divided by sales, so it'd be 2.62%. So notice that this percent of sales approach doesn't require that my net profit margin stay constant. Now I can calculate my additional funds needed. Take my increase in assets, subtract my increase in spontaneous liabilities, and subtract my change in retained earnings. So this predicts that I need $179 in external financing. And let's say I want to split this equally between notes payable and long-term debt. Let's say that notes payable has an interest rate of 5% or 5%, and long-term debt has an interest rate of 7%. So now I know that my notes payable will rise by half of this. So over here I can come to notes payable for 2013, take the previous year's notes payable and add to it half of my external financing needed. Now it doesn't have to be split equally. It could be 70% with notes payable, 30% with long-term debt, or 0 notes payable, and the rest a combination of long-term debt and equity. But now that I have notes payable, I can find my current liabilities by adding accounts payable and accruals and notes payable. Long-term debt will be the previous year's long-term debt plus half of this external financing needed. Common stock isn't going to change. Retained earnings would be the previous year's retained earnings plus the addition to retained earnings that I expect to generate in 2013. So my total liabilities and equity would be retained earnings plus common stock plus long-term debt plus notes payable. So it balances. But now I have problems because I've got this extra debt. So my interest expense isn't really going to be 16, it's going to be something more. So to figure out my new interest expense, or what they call the financing feedback, essentially I looked to see how whether or not I needed any external financing, and I did. So how am I going to raise that? I'm splitting it half between notes payable with this interest rate, half between long-term debt with this interest rate. And maybe I had split it partly with issuing new stock as well, which would mean I'd have to pay dividends on that. So financing feedback is looking at how you're going to raise this financing and decide if it's going to impact your interest expense and how much, and if it's going to impact your dividends and how much. Here it will only impact our interest expense. Basically, I'm taking half of this 179 and I will owe 5% on it through notes payable. I'm just going to, I'm not quite finished, but I'm going to go ahead and press enter so we can see that that extra notes payable I'm borrowing will mean we'll have to pay an additional $4.48 in interest. I also, though, have half of this 179 coming from long-term debt, and that has a 7% rate. And just so I feel better, I'm going to group these with parentheses. I think I'm okay in terms of order of operation, but I'll just make sure I am. So I'm saying take the notes payable times its rate plus long-term debt times its rate, then add them together. So I am predicting I'll owe an extra $10.75 in interest expense. Now essentially what that's going to do is up my interest expense to $26.75 from what I had originally assumed of $16. So on the second pass, I can essentially pull sales from the original pass, variable costs from the original pass, fixed costs from the original pass, use the same formula to calculate EBIT, but now when I go and I deduct the new interest expense level. So I'll take EBIT minus interest to get my new earnings before taxes. Take that 40% tax rate times my taxable income to get my new taxes. Take the new EBT minus my taxes to get my new net income. Profit margin I don't actually need. Dividends will be 30% times my net income, and retained earnings will be net income minus my dividends. So this is my new net income level. So instead of retained earnings actually jumping up to 245, it's going to be the 200 plus this 4126. And these aren't going to change. I'm going to just see if I can do it. I can't quite do it that way. I'm just going to create links here, copy that over, create a link here. So essentially, since these aren't changing, I'm just popping them over to 2013. These aren't changing because additional interest expense is only going to reduce my taxable income and my net income and my addition to retained earnings. So it won't actually impact these values. So I'm just pulling them over. But when I go to calculate retained earnings, it's the new retained earnings value. And now I can just copy this formula over. And here is my new total liabilities and equity. Well, these values won't change from their previous values. So this column right here would be identical to this one right here. So I know this has to total $12.50. Total assets don't equal total liabilities and equity because retained earnings is about $4 smaller than it was before. So essentially, if I take the difference in retained earnings, this $45.78 and the $41.26, I'll get $4.50. That tells me how off my balance sheet is now because it's not balancing since retained earnings are a little bit lower than I originally thought. Or I could take $12.50 minus this $12.45 and I'll still get 4.52 that I got right there. So essentially, because of the extra interest expense that I received from the feedback, it means my retained earnings are going to be 4.52 smaller than I'd originally thought. So what we do, I'm running out of space here. and I didn't add enough. What we do is say, well, from the second pass, we got our financing feedback. And that tells me I really need to borrow, in addition to the $179 I originally thought, an extra $4.52. So my total external financing needed would be the original $179 plus the $450 to get me up to $184. Now I could even do a third pass. I would split this extra $4.52 among notes payable and long-term debt with their associated interest rates, and I could come over here and do a third pass. I would pop that extra interest that I'd pay on this extra $4.52 right here. That then is going to impact my retained earnings all the way through. And so I could get financing feedback from a third pass. And I could just keep doing this again and again and again until my number got awfully close to zero. It doesn't usually take very many passes to get your number really close to zero. Now I want to show you why this method is better than the external financing needed equation. First of all, I can easily adjust growth rates. If I expect to grow at, let's just say 15% instead of 25, I think I pressed the wrong button somewhere. Let me hit undo and see what happened. Where did I get this from? Oh, I just typed that in and I should have linked it. I should never type things in like that. Okay, so if this was going to be 15% instead of 25, so I'm not growing as rapidly, I won't need as much external financing. So I can just very quickly tell that. Another question that companies like to know is their sustainable earnings or sustainable growth rate. Basically, it is how fast can a company grow before they need external financing. So how fast can they grow using only internal or spontaneous financing? So essentially, how high can this growth rate be so that your external financing is equal to zero? So I'm actually going to use this first pass ESN, try to figure out what growth rate this needs to be. So this first pass EFN is 0. So to do that, I would go to Data, What If Analysis, Goal Seek, and I want to set this first pass EFN number to 0 by changing my growth rate. And this rate of 4.11% is called the sustainable growth rate. Now they show you a long, complicated equation in the textbook to solve for that sustainable growth rate, but you don't need to use that. You can just set everything up in Excel and use Goal Seek. I'm going to pop this though back to 25%. Another thing that we could do is assess individual accounts and see whether we think we're being efficient on that. For instance, I might be interested in evaluating my accounts receivable. I'm not sure how much exposure you've gotten to financial ratios, but something that a lot of businesses are interested in and should be interested in is their average collection period. It's also called days sales outstanding. It essentially represents how many days on average it takes credit customers to pay. So to calculate it, what I can do is take my accounts receivable, and I'm using 2012's values, divide by my average daily credit sales. So my total sales are 2,000, and I'm just going to assume they're all on credit. To convert them to daily by dividing by 365, So on average, it takes my credit customer about 44 days to pay me. Well, if my terms of trade are 210 net 30, that's not particularly good because on average, each customer is paying late. Now, if my terms of trade are net 45, then they're paying right before it's due, and that's exactly what I would expect. But maybe I want to try to get my average collection period down to, let's say, 35 if my terms of trade are 210 net 30. I don't necessarily want to try to get it all the way down to below 30 right at the beginning, in one fell swoop, because I might lose some customers that way. But maybe start tightening up on your collections fairly slowly at first. So basically, I can decide upon a desired average collection period and assume I can take steps to accomplish that. What would happen to my accounts receivable? Well, people would start paying me faster and this balance would drop. So let's say I'm trying to accomplish a value of 35 days for accounts receivable. So I'm just going to type 35 here. And actually, I'm not going to type 35 there. What I'm going to do is input the same equation that I did for G6, but relative to 2013, not 2012. So if I follow the same 12% of sales policy for accounts receivable, and they do go up to 300, my average collection period would be the 300 divided by 2013 sales divided by 360 or 365. So my average collection period in 2013 would be the same as 2012. But now, if I know I want to try to get this number down to 35, what I can do is go to GoalSeek and say set I5 to 35 by changing 2013's accounts receivable. Oh, actually, I'm glad that happened. I'm going to hit cancel. And it gave me an error message. It said cell must contain a value. When I look at my cell D5, the one that I was telling Excel to change, it contains a formula and not a value. Excel will not run GoalSeek on a cell that contains a value. A formula. So I'm just going to type 300 in here. And now I can go back to what if GoalSeek set this cell to 35 by changing my accounts receivable. And it's essentially saying that if I do institute more strict policies on the people who are paying late, and I can manage to get my average collection period down, accounts receivable wouldn't pop up to 300. They would actually stay right about where they were before. And hopefully, this does flow through and impact my EFN. And it does. I think that was about 180 before, and now it's dropped because I don't need as much accounts receivable. And I could do the same thing with inventory. Maybe I'm trying to hold my inventory for fewer days. Or maybe I've normally been paying my accounts payable the day I get the bill, and I could prolong that payment a little while without adversely impacting my credit record, so I could actually extend my accounts payables. This number would rise a little bit, and that would help me in terms of EFN because this number would be a little bit larger and it would make my EFN smaller. So essentially using this method lets me get down to the nitty-gritty and see exactly what's going on and how changes will impact my AFN. And I could also calculate financial ratios and see how these changes would impact those.